Have you ever heard this? You are listening to IBGR, the International Business Growth Radio Network. That's our call sign. It is our name. It's also our URL and our broadcast frequency. My name is William Eastman. I'm the host for today's show, and we are doing a series, as we always are here. We're always doing a series of shows. None of these shows are not related to something else. The series is on the New World Business Economics. Now, I'm calling it Neo World, out of homage to the latest Matrix movie that's coming out. But I like the word Neo anyway. And so I'm trying to help business owners look at the economy and make sound decisions about what's happening. And this is indicative of any economy. This is not isolated to the United States or to North America or to Europe or Africa, India, Australia, New Zealand, any place else. Any place that has a market-based economy of some sort has these factors going on. And here is the deal. The premise behind today's show is pretty simple, as it is in the series. If you go beyond our willingness to vote, not that it makes a difference a lot of times, sometimes it does, but the reality is we as business owners, as entrepreneurs, as executives of fast start companies, we don't affect the economy. It is out of our hands. And one of the lessons I learned a long time ago in one of my first businesses was control the controllables. Well, I don't control the economy. All I can control is my response to it. And what you need to do is you need to say to yourself, first of all, I cannot assume that everything that I hear as the pundits talk is actually true. All right, because they all have their own agendas, number one. Number two is the stock market is a pretty good indicator of what's going on, but not necessarily will it dictate or explain everything that's happening on Main Street. So you got Wall Street, you got Main Street, if we use the United States as an example, but it's the same if we're talking in England, and I believe it's Fleet Street. Same thing. So here's the deal. Since you can't control what happens, all you can control is your response. And if you know what to do, if you can read the economy, you can get past all the BS that's going on out there, and you know what to look at, you can decide what is in the best interest of your company, your employees, your investors, your customers, because we're all in this together. And, of course, I should have added suppliers. We're all in this together. And so what I'm doing in this series is taking you through the things to consider. And a quick analogy on my background, probably the best way of saying it is I am not a professional economist. I'm self-taught. And I'm self-taught simply because when I was doing large corporate consulting and I was working in the areas of strategy, and you were talking multi-billion-dollar firms, they all have economists. Every one of those companies have economists who you have to work with. And the last thing I could do is show up at a meeting, especially if you're selling high-priced services, and be an economic Luddite. So from that, I built my own reasonable level of competence as an economist so I could talk to economists. And now I've carried that over to businesses. This is my fifth company that I have right now, and that's IBGR. I'm the founder here, also the managing partner. So I'm not only sharing things with you that I believe you should be doing, I'm sharing things with you that we're doing. All right, so you need to go to the website, ibgr.network. That's ibgr.network. When you get there, you'll find a navigation bar on the home page. Go all the way over to resources, mouse over. You'll see a pull-down menu. Go to show notes. And if you're listening to this live, odds are I'm at the top of the queue. And it says Neo World Biz Econ, Show 3. New World Business Economics, Show number 3. In the Shadow of the Wave. Now, what we did in the previous two, so that's 8 podcasts, as we talked about the business cycle itself, and the inflection points, the few things that you really, technical things you need to know. If you know this, you know everything. Well, you know enough. The rest of it you can teach yourself. All right, so now if you scroll down, let's get started here. All right, so I'm going to start at the beginning of the business cycle. We could start this conversation any place, and the temptation is to start where we are today, at least in the North American economy. But if we look at the global economy, I believe it's also indicative of that. But we're not going to get to that for another couple of shows. My guess is This is show 3, probably late show 4, early show 5 is where we're going to get in this conversation. The location is at the absolute market bottom. Now, what I mean by that is if I use a ocean analogy here, because one, I was a marine scientist for a good part of my early life. And number two, is it smart to look at the economy as the business cycle as a series of waves that move through the economy? And they range, and depending upon how you measure, some people measure peak to peak. I measure trough to trough. So from trough to trough, you would have anywhere from, I've seen as short as 3 to 4 years or as long as 12. All right? So that's how long it takes the business cycle to go through. The more you have a market economy, the more this is true. The less you have a market economy, the flatter the wave. And the reason for it is simple, is government intervention has prevented the expansion from growing as much as it can and has prevented the contraction to be as severe as it will be. And the reason for the contraction, which is what we're coming out of, is to clean out the market from all the bad decisions that were made. And we'll talk about that in the series here. All right, so since the market uses price for information, the demand for most products and services makes reasonable prices unsustainable. All right, now, so let me just hit that fast before we get into episode 9, which is the one we're doing right now. See, what's going on here is that if I want to understand market dynamics, it's really simple. I look at the balance of supply and demand. And it's really simple. When there is more supply, more available goods and services than people want it, then the price is going to go down because you've got more stuff chasing fewer dollars. On the other hand, if the demand is much higher and the supply is low, the price goes up because now you have people competing for the limited resources, and therefore it drives up the price. So if I understand that, price is the mechanism that the market operates from. It reads the price, and if the price is low or going down, it tells them that there's an oversupply in the market or demand is increasing. On the other hand, if price is going up, it's relatively high now and it's going up, then it's telling you is that, we are in expansion and more people are buying it. And I'm going to hit on this a lot, but I want to lay that out. And by the way, I did it on all the other episodes. So based upon episodes in podcast 6 and 7 from my last show, we're going to start at the darkest point in the economy. Nobody is sure if the worst is over, or is there going to be more kind of general angst and disgust in the market. And so understand, it's got the old saying, the night is the darkest right before the dawn. Well, here, what we got here is we're in the trough between two big waves. It's dark down here, as a sailor who's been in those heavy seas. Now, it's critical for the business owner to have the courage to move early before everybody else. And that is one of the basic premises here, is that you must know when to move. You don't have to be first, and we'll talk about that a little bit later in one of the other episodes, but you want to be early. And there's a bunch of reasons why that is brilliant move by you, because more than likely, like everybody else, you've been hit economically by the contraction that you're just coming out of. So you want to replace that lost revenue and kind of build some momentum. That's what you want to do. Now, we talked about inflection points, so I'm just simply going to go back and hit this. We're in the trough, all right? At the very bottom, the lowest point of the previous cycle and the starting point for the next cycle. In the business stage, we're going to call this number 1, new opportunities, all right? So, and I think that gives away what you're to do as a business owner. So just a quick review of inflection points. You have the trough, you have the midpoint of the wave on an expansion, you have the crest, you have the mid-wave, you have the midpoint on a contraction, and now you're back into the trough. So those are the inflection points that you're looking to read, all right? And what it represents, the trough is it never will get worse than this. The crest is it's as good as it's going to get. And then on the expansion, the inflection point is when prices begin to now exceed reasonable value. And therefore, you've heard of the bubble. That's when the bubble starts. And that's part of the reasons why a market goes through this cycle. People start making bad decisions on the economy. And the reason for it is you have trailing indicators, you have real-time indicators, you have predictive indicators, leading indicators. And so sometimes you're reading the wrong things, and when you start reading the wrong things, you start making bad decisions. On the other side, on the expansion, that inflection point, halfway down the contraction, is that at about midpoint, you've cleaned out all the clutter from the market. Prices come back down. It's reasonable. But now in the bottom part of the contraction, prices actually go down to where you might not even be able to break even by selling what you have. And so that is a negative bubble versus a positive bubble. All right. And so that gets to my final point before we go to break. Is that there's a lot of different economic models out there, and what most of them suffer from is they are all based upon the fact that people make reasonable economic decisions. And the answer to that is, in the long term, that's probably truer than not. In the short term, it isn't true, because the psychology of the market, when you have a bubble, the reason you have a bubble is you have this kind of euphoria. It goes from enthusiasm to euphoria, and now people believe the market can never go down. And what you see is the savvy investors are starting to get out because they're going, this is overvalued, a bubble. And all the people who have been on the sideline who have been fearful of getting in the market have now jumped in. Now, I'm talking about that in stocks, but it's also true with businesses, is that do we expand a production line, or do we get into a business that's maybe ancillary to what we do because everybody's buying it? Well, if you make those decisions early, it's a smart move. If you're making these decisions late at this point, then you are betting on something that isn't going to continue. And that's what the bubble's about. And it's emotional and it's psychological. Now, if you go to the bottom of the notes, I want to bring your attention to a couple things. First of all, make sure you get this entire series. There's show notes. Go there. I think you got to cut and paste them. You can't download them yet. Cut and paste, and just take these notes out and use them. Also, number two is that we've got an app where you can get, basically us on speed dial. And so if you click that, download the app. That's at ibgr.app, app. And we're going to be doing this all the time. In fact, all the news that we run on this station is all economic news. And then finally, I want to announce our newest partner, and that's Audia, or Audio Idea, or Audia. I guess that's the best way of saying it. And they are part of our new Library of Business podcast. And there you have a link that will take you to their website. So, okay, let me get out here as we break up on the first one. My name is William Eastman. This is IBGR. This series is New World Business Economics. This is show 3 in the Shadow of the Wave. Go nowhere. We'll be right back.